Hello, good day everyone. My name is Francis Darlene Sultan Kaitom and I am the first reporter of Group 3 and our topic was all about regular income tax inclusions in gross income. Okay, so items of gross income. The term items of gross income or inclusion in gross income is a broad category pertaining to all items of income subject to taxations, namely gross income subject to final tax, gross income subject to capital gains tax, gross income subject to regular tax. So, items of gross income subject to regular tax. So, gross income includes but is not limited to the following items. So, compensation for services in whatever form paid, gross income from the conduct of trade, businesses or exercise of a profession, gains derived from dealings in properties, interest, rents, royalties, dividends, annuities, price. So, compensations for services in whatever form paid. So, under current tax rules, the term compensation income technically pertains to the types of employee benefits that are subject to regular tax. So, the fringe benefits of managerial or supervisory employees are not considered compensation income but are subject to final tax. So, to minimize the complexity of this section, compensation income is separately discussed in Chapter 12. Okay, so gross income from the conduct of trade, business, or exercise of a profession. This includes income from any trade or business, legal or illegal, and whether registered or unregistered. So, gross income from businesses or profession is determined as follows. So, sales, revenues, receipts, fees, less cost of sales or services is equals to the gross income from operations. So, the following businesses' income shall not be included in gross income subject to regular income tax. So, businesses' income exempt from income tax. Number 2, businesses' income subject to a special tax. And number 3, businesses' income subject to final tax. Okay, so take note that taxpayers with multiple types of business income shall report their gross income subject to regular tax under the column regular in the computations of tax per regime in the annual income tax return. So, gross income subject to a special rate and thus exempts are presented respectively under the columns total special and total exempt. Okay, so gains from dealings in properties. So the gains or losses in dealings in ordinary assets are subject to regular income tax. Dealings in capital assets other than domestic stocks and real properties are also subject to regular income tax. So ordinary gains are included as items of gross income. Ordinary losses are items of deductions against gross income. Net capital gains from other capital assets after deducting capital losses is also included as an items of gross income. So, a net capital loss is not an item of deduction against gross income. So, to avoid complexity, gains from dealing in properties are discussed in detail in Chapter 12. Okay, so interest income. There are examples of interest income subject to regular income tax as you can see, and there are also exempt interest income. So, the following are exempts from regular income tax. So, number 1, interest income earned by landowners in disposing their lands to their tenants pursuant to the Comprehensive Agrarian Reform Law. And number 2, imputed interest income. Imputed interest income, the opportunity cost of money, does not constitute an actual income, hence it is not exempt from income tax. So take note that the power of the commissioner to allocate income and deduction does not include the power to impute theoretical interest. So I have here an illustration. Sapphire Bank has the following income. Okay, so interest income from loans, which is 3 million. Interest income from deposits with other banks, which is 400,000. Interest income from notes rediscounting, 100,000. And interest income from treasury notes, which is 50,000. Okay, so only the interest income from loans and notes rediscountings are items of gross income subject to regular income tax. So the interest on deposits and treasury notes are items of gross income subject to final income tax. Okay, next would be the rent. Rent income arises from leasing properties of any kind. It is a passive income but is not subject to final tax under the NIRC. Hence, it is not subject to regular income tax. So, there are special considerations on rent. So, obligations of the lessor that are assumed by the lessee are additional rental income to the lessor. And number 2, advance rentals are the following. As you can see, there are A and B. And number 3, leasehold improvements made by the lessee on the leased property are recognized by the lessor as income using the spread out method or outright method discussed in Chapter 4. So, as you can see, I have here an illustration. Under the Escalante Corporation Standards lease contract, leases shall run for a non-preterminable 12-month period for a monthly rental of 25,000. So, the lessee shall pay 3 months rental in advance plus 1 month security deposit. So, the rent for the last 2 months of the lease shall be taken from the advance while the security deposits will be returned if there are no damages sustained by the property during the lease term. So the entire 75,000 rental payments for the current month and the advanced rental for the last 2 months is an items of income subject to regular tax, while the 25,000 security deposit is not an income. Okay, so royalties. Royalties earned from sources within the Philippines are generally subject to final income tax except when they are active by nature. So, active royalty income and royalties earned from sources outside the Philippines are subject to regular income tax. So, illustration I have here, as you can see under robotic technology design is a distributor of a computer program and earns royalty from its licensed users. Computer programs are specifically tailored to each client and regular continuing maintenance services are provided. So during the year, client users remitted a total of 500,000 royalty payments. So the entire 500,000 is subject to regular income tax since the royalty is an active income to robotic technology design. So illustration 2, McDonald has the following royalties. Okay, so royalties from mining properties in the Philippines, 550,000. Royalties from books published in the Philippines, 200,000. Royalties from books published abroad, 300,000. And royalties from franchise exercise abroad is 400,000. So the royalties from mining properties and from books in the Philippines are subject to final tax, while the royalties from sources abroad aggregating 700,000 are items of gross income subject to regular income tax. So remember that the final withholding tax does not apply to foreign income. So next would be dividends. Dividends, this pertains to dividends declared by foreign corporation. It should be recalled that dividends declared by domestic corporations are generally subject to 10% final tax if the recipient is an individual taxpayer and exempt if the recipient is a domestic or a resident foreign corporation. So cash, properties, and scrip dividends from foreign corporations are generally items of gross income subject to regular income tax. So stock dividends and liquidating dividends. So stock dividends, it should be recalled that the stock dividends are exempt from income tax, but when the declarations confers the recipient a deferent interest or right after the stock dividend declarations, or when stock dividends are subsequently redeemed such that it amounts to payment of cash dividends, the fair market value of the stock dividends received is taxable. So in liquidating dividends is not an income. Take note, liquidating dividends is not an income. The liquidating dividends are considered an amount in exchange for the investment of the investors and are subject to the rules of dealings in properties in Chapter 12. So I have here an illustration. Lubao Company, a domestic corporation, received cash dividends from the following: domestic corporations 400,000, resident foreign corporations 200,000, and non-resident foreign corporations, which is 300,000. So the 400,000 intercorporate dividends declared by domestic corporations is exempted from final tax. Therefore, it is not an item of gross income subject to regular income tax. While the 500,000 total dividends from the resident and non-resident foreign corporations are items of regular income subject to regular income tax and shall be reported as follows. So there are two scenarios. Assuming Lubao is a domestic corporation, so the 500,000 total dividends from foreign corporations shall be included in gross income because domestic corporations are taxable on world income. And the scenario 2, assuming Lubao is a resident foreign corporation, only a portion of the 200,000 dividends from the resident foreign corporations determined as earned within by the predominance test shall be included in gross income. The situs of dividends from the non-resident foreign corporations is abroad. So that's all. Thank you.
Conditional exemptions on intercorporate dividend from NRFCS. So, dividend received by domestic corporations from non-resident foreign corporations is generally subject to regular tax. So, ang makareceive sa dividend is ang domestic corporations. However, they are exempt if the following conditions are fulfilled. So, number 1, the domestic corporate recipient directly owns at least 20% in value of the outstanding shares of the NRFC. So, kay domestic corporate man siya, within unit siya, so pwede siya ma-exempt. Number 2, the shareholdings in the NRFC must have been held uninterruptedly for a minimum of 2 years at the same time of dividend distribution or throughout the entire existence of the NRFC. It is operational for less than 2 years. So, pwede siyang ma-exempt if ma-fulfill niya ang condition. Number 3, the foreign source dividend received or remitted must be reinvested within the next taxable year in business operations of the domestic corporation such as the following: A. Working capital requirements. B. Capital expenditures. C. Dividend payments. D. Investment in domestic subsidiaries. And E, infrastructure projects. So, kailangan iyang i-reinvest dito sa business operations ang dividends nga iyang ma-receive para ma-exempt siya sa regular income tax. Per RR 5 2021, foreign source dividends that are not utilized within the following taxable years shall be considered taxable income in the year received, subject to surcharges, interest, and penalties as applicable. So, we have here the illustration 1. A domestic corporation received the following income distribution from the following investments, which was all acquired 3 years ago. Subsidiary corporations are more than 50% owned, while associates are at least 20% owned by the investing company. Since all requisites are fulfilled, dividends from these NRFCS are exempt from regular tax. The dividend from domestic investees is exempt under final income tax. The foreign branch profit remittance is not subject to tax since the branch income are already taxed as part of the regular income of the combined domestic home office and the foreign branch. The profit share from foreign partnership is not exempt since the create exemption is limited to dividends. Illustration 4. RLT Corporation received dividends from the following investments in foreign associates, which is held at least 20% interest for more than 2 years. The 1 million pesos unused dividends from A Corp shall be declared as taxable income for 2021, subject to surcharges, interest, and penalties since it was not utilized in 2022. The 1.5 million pesos of the dividends from B Corp is exempt. The 0.5 million pesos dividends shall be declared as taxable income in 2021 subject to surcharges, interest, and penalties since it was not used in 2022. The 2 million pesos dividends from C Corp is exempt. The 1 million pesos unutilized balance in 2023 shall be considered taxable income in 2022 subject to surcharges, interest, and penalty. Annuities. The excess of annuity payments received by the recipient over premium paid is taxable income in the year of receipt. So, when we say over premium paid, we have illustration here. Andrew purchased an annuity contract for 100,000 pesos, which shall pay him 10,000 pesos annually until he dies. So, si Andrew Locono nipalit og contract for 100,000 pesos pero bayaran siya sa iyang gipalitan og contract og 10,000 annually until siya mamatay. So ang 10,000 pesos for 10 years it is 100,000 pesos. So mao na ang premiums nga iyang ginabayaran. So pag ma-collect na ang first 10 annual annuity is ma-exempt na siya because the receipt of first 10 annual annuity payments is a return of capital. So prizes and winnings. Prizes and winnings that are exempted from the tax are not items of gross income subject to regular income tax. For prizes, 10,000 pesos and below, regular tax within the Philippines and regular tax abroad. More than 10,000, final tax within the Philippines, regular tax abroad. PCSO, winnings exceeding 10,000 pesos, final tax within the Philippines, not applicable abroad, kay walay PCSO sa abroad. PCSO winnings not exceeding 10,000 pesos, exempt within the Philippines and not applicable also sa abroad. Winnings from other sources, final tax within the Philippines and regular tax abroad. In this illustration, the city of Baguio shall withhold 20% final tax on the winnings of Mr. Sebastian. The price of John Hay Corporation shall not be subjected to 20%. Final tax but to creditable withholding tax. John Hay shall include the price in its gross income subject to regular income tax. Pensions. These pertain to pensions and retirement benefits that fail to meet the inclusion criteria and hence subject to regular tax. So, in order to meet the exemption para sa pension, dapat dili siya fail. So, pag dili nimo ma-meet ang condition nga dapat nimong i-comply, ma-subject siya to regular tax. Partners' distributable share from the net income of the general professional partnership. It should be recalled that general professional partnership are not subject to income tax. Example, final tax, capital gains tax, or regular income tax, because they are merely viewed as pass-through entities. The partners are the ones subject to regular tax on their share in the net income of the general professional partnership. So, diri nga illustration, gipakita nga ang share ni Ket o ni Siegfried sa ilang gross income is subject to regular income tax. Business partnership and taxable joint venture or co-ownership. These entities are subject to corporate income tax. The distributive share of a partner, venturer, or co-owner from the net income of these entities, if organized within the Philippines, is subject to 10% final withholding tax. However, if these entities are organized or constituted abroad, The share from their profit is subject to regular income tax. For taxpayer taxable on global income, it should be recalled again that the final income taxation is territorial and does not apply to foreign income.
Under the NIRC, the regular income tax is catch-all provision for income derived from whatever sources that are first, is not subject to final tax, capital gain tax, and special tax regime. And the second is not excluded or exempted by law, treaty, or contract from taxation. So, there are 6 other sources of gross income subject to regular income tax. So first, in income distribution from taxable estates or trust. So there are 2 illustration of estates and trust. At di na ko siya explain kay ginadiscuss na siya in chapter 3. So, dili ta sunod sa share from the net income of exempt joint venture and co-ownership. So, dili dapit ginadiscuss na po rin siya. So, dili na ko siya i-explain pa. So next, dito sa farming income. So, farming income operation can be classified as 2. First is the raise and sale operation, and the second is purchase and sale operation. So, kaning duha ka buok farming operation can be classified. Dito na ko siya explain kay I know na kabalo na mo sa ipasabot ani. So, sunod dito sa recovery o past deduction. So, in recovery o past deduction, there are 6 examples. So, muna yung example. So, next, in the tax benefits, there are 2 ways of taxpayer may benefit from a deduction. So, first, direct day, and the second is indirect day. So, dili dapit sa mga theory, dili kayo ta mag-explain pag-ayo kay sabotable na kayo siya. So, dili ta mag-focus about sa mga illustration. So, there are 6 illustration. Illustration 1, 2, 3, and 4. Ginadiscuss na po ni siya. So, dili na kayo nato ni siya i-explain pag-ayo. So, dili ta sa illustration 5. So, dini, about siya sa without benefit of no carryover. So, dini, ako ni siyang i-discuss or i-explain. So, before bad expense in 2020, total amount of 70, bad expense recovery, total amount of 90. So, ang iyang net income after bad expense, total siya og 20,000, which is ang 70,000 ug 90,000, gi-minus siya. So, nayamo siyang 20,000. So, in 2021, ang net income before bad expense is 100. But wala man siya bad expense, so dili siya butangan. So, kung unsay ang net income before bad expense, dito sa after, mao po na yung amount, 100,000. So, net income before bad expense, 100,000 in 2021. So, in 2022, ay ang net income bad expense kay 120. Ang iyang bad expense recoveries, total amount of 60. So, 120 and 60, total amount of 180,000. So, muna yung net income after bad expense. So, that is the illustration. So, dili na may gina-assume the future recovery is known that 2020 net income should have been. So, the illustration is net income before bad expense, total amount of 70, and the less bad expense recovery is known, 90,000 and i-minus just 60, so total amount of 30. Muna yung less bad expense if recovery is known. So, the net income if recovery known, total amount of 40,000. So, muna yung gina-assume sa future recovery sa 2020. So, dili sa the tax benefit is the income that escaped taxation in 2020 computed as. So, the total gap po siya of tax benefit after the bad expense of 40,000, which is ang iyang net income of the subsequent recovery is known is 40,000, which is nakita na dito sa gina-assume sa 2020. So, ang less net income as reported in 2020, recovery is known. So, unknown man, wala. So, 0. So, the total amount is 40 in the tax benefit of the bad expense. So, next illustration, which is illustration 6. About taxpayer is exempt in the year of deduction. So, the illustration. So, in 2020, net income before bad expense, total amount of 70,000. And the bad expense recovery, total amount of 120, which is minus siya. So, the total amount of net income after bad expense in 2020, 50,000. So, in 2021, the net income before bad expense, total amount of 100,000. And the bad expense recovery, which is 40,000. So, the total amount of net income after bad expense in 2021, total amount of 140,000. So, that is the illustration 6 about the taxpayers is exempt in the year of deduction. Next, about the refund of the non-deductible expense. So, ang pasabot ani niya, expense or payments which are not deductible gross income in the computation of taxable net income will never create tax benefit to the taxpayer. So, sa refund of non-deductible expense na siya, si 5 ka following non-deductible items is not taxable. Mo niyahang 5 ka non-deductible items is not taxable. So, di na ko siya i-explain para matag isa-isa, kaya kabalo na mo kung unsay pasabot ani. So, muna ang refund of non-deductible expense.
Hi, my name is Chandra Tayone, one of your reporter in Chapter 9, which is the regular income tax, inclusion in gross income. We have here reimbursement of expenses. So reimbursement of expenses is an expenses of the taxpayer that are reimbursed or paid by the customer or client constitute additional income to the taxpayer. For those who don't know, reimbursement is to pay back to someone. We have two examples here. First example, or illustration, when the lease pays the ownership cost of the lessor, such as property tax and insurance on the property, the payment constitutes income to the lessor. Second, when the client reimburses the out-of-pocket expenses of the professional practitioner, the reimbursement are income to the practitioner. So next, we have here the cancellation of indebtedness. The cancellation of indebtedness may amount to gratuity or payment of income. So either two lang siya. It's either gratuity or payment of income. The cancellation of debt is, we have three here. The consideration of service or goods. So this one is treated as income. Next, we have as an act of gratitude. So this is not treated as income. This is treated as income. So for your clear understanding, it's more likely to tip siya. The last one is capital transactions such as forfeiting the right to receive dividends in exchange of the debt, treated as dividend income. So this one is for corporation. Let's proceed to the special consideration in reporting of gross income. We have 5 here. First is the accounting methods, then citus rules, effect of the value-added tax, creditable withholding tax, and lastly, the power of the CIR to redistribute income and expenses. First, accounting method. Accounting method adopted by the taxpayer has a direct effect on the reportable amount of gross income subject to regular income tax. For an instance, cash basis taxpayer will report their gross receipt or collection as gross income, while accrual basis taxpayer will report their revenue consisting of collected and uncollected income as a gross income. So it must be recalled also regardless of the accounting method of the taxpayer. Advance income must be included in the gross income in the period received. So we have here citus rules. So our short recap, citus is a place of taxation. So citus of taxation also affect the extent of income included as items of gross income of the taxpayer. It must be recalled that all taxpayers are taxable only under the Philippine income except resident, citizen, and domestic corporation, which are taxable on the global income. For taxpayer taxable in the Philippines income, only their items of gross income subject to regular tax from sources within the Philippines are included in the gross income. For taxpayer taxable in global income, their items of gross income subject to regular tax from sources within and without the Philippines are included in the gross income. Next, we have effect of the value-added tax on the reportable gross income. Remember that business taxpayer are required to either registered as VAT taxpayer and non-VAT taxpayer. Take note that a VAT taxpayer is their sales or receipt exceeds on 3 million in the last executive 12 months, while the non-VAT taxpayers, if their sales or gross receipt is below that VAT threshold or are specifically designated by the law to pay percentage taxes. Every taxpayer is mandatorily required to charge 12% output tax on their sales or receipt. The regulation presumes that the amount charged to customers is inclusive of the 12% VAT. The output VAT will be paid to the government net of the VAT paid by the taxpayer on his purchases. As such, the amount of the reportable gross income shall not include the output VAT. Next is creditable withholding tax. Creditable withholding taxes, or CWT, deducted by income payer against the gross income of the taxpayer are not inclusion in the gross income. This should be added back to the reportable amount of the gross income. Creditable withholding taxes are tax credits that are deductible against the annual income tax due of the taxpayer.
So my topic is all about
The power of the CIR to redistribute income and deduction. In the case of two or more organizations, trades, or business owned and controlled directly or indirectly by the same interests, redistribute income aims to provide every family with a basic standards of living so as to prevent poverty. The transfer pricing guidelines to limit these unfair practices, the BIR and the Department of the Finance promulgated Revenue Regulation Number 2 Series of 2013 on the transfer pricing. So, we have here the example of the associated enterprises. First, parent corporation and its subsidiary corporation, sister companies, all corporation controlled and under the same holding company, businesses owned by the same person. Next is the arm's length principle shall be applied to cross-border transaction between associated and domestic transaction between associated enterprises. So, next is the when the operation are conducted cross-border, the taxpayer may be entered into advance pricing agreement. Take note that. So next is the transfer pricing method. There are 5 methods. First is the comparable and controlled price. Best for a standard tangible goods sold on a open market. It does not apply those patented products. Second, resale price method. This used when products purchased from a related party. Third, cost plus method, measured by valuing of the function performed by the supplier of the property. Fourth, profit split method. 2 parts, residual profit split approach. Profit is first allocated to provide basic return. Second, contribution profit split approach. The combined profit from controlled transactions are divided into associated enterprises. Lastly, transaction net margin method. This is similar to cost plus and the resale price method. So, this is the illustration of with an advance agreement. So, as you can read the screen, na siya 150% of cost. Then, mo ni siya ang illustration, ang Philippines, then branch, then abot siya sales of to unassociated domestic enterprises. So, there is obos, makita ninyo na i-apply ang EPA, which is the advanced pricing agreement. So, as you can see, sales through the branch intra-company sale, ang sale niya, di ba, ang sale niya diri sa taas is 7 million lang. So, pag-abot diri, nahimo siyang 10,500,000. Why man nahimo siya ingon ana? Asa siya gikan? Ang 7 million, gi-times siya 150%, which is ang katong kuha niya, EPA. So, mauna na siya. We know that already. So, ang gikapi lang gihapon siya, mauna siyang nahimong ingon ana. So, iles lang gihapon siya ang 10,500,000, iles nimo siya sa 7 million, then ang gross income is 3.5 M. So, sa outside, parihara gihapon, iles lang gihapon siya, then ang total niya, 12 million, 7 million, then iles lang gihapon siya, ang gross income overall is 5 million. So, there is a sales of unassociated domestic enterprises. The sales is the 3 million. As you can see above, 3 million, then less nimo ang 1.2 M, gross income niya is 1.8 M, then total gross income is 5,300,000. So, diri sa taas is yan lang gi-copy ang 1.5, as you can see, makita ninyo, ang total sa outside, gi-copy lang niya sa total gross income diri sa domestic enterprises, so 1.5 M. So, the total gross income nila is 6.8 million or 6,800,000. So, second illustration, as you can read, with illustration to without an advance pricing agreement na siya. So, as you can see, sales niya is 4 million. Iles nimo ang cost of sold, 3.5 M. So, gross income is gapon siya, 500,000. Scenario number 1, the BIR determined that the HOT Corporation is billing its branch at 200%. Philippines Independent Distributor at an average of 150%. So, as you can see in the screen, cost of sales, 20% times cost, so 3.5. Cost of selling party, 3.5. 25 M times 200%, so 1,750. Cost arms length price, 150% times 1,750,000, so 2,625,000. Thus, the gross income of HOT Corporation shall be restated as follows. So, sales, 4 million, which is na diha makita, 4 million sales niya. Then, ilas ang cost of sold nga arm length cost, 2,625,000. So, gross income is 1,375,000. Take note that HOT Corporation will be given assessment by the BIR for the incremental tax plus penalties that may be due from this restatement. Next, period in which items of gross income are included. The amount of all items gross income shall be included in the gross income for the taxable year in which received by the taxpayer unless under methods of accounting permitted, any such amount are to be properly accounted for as of a different period. So that's all my topic, and Aris Pasagdan, the reporter for this video.